In this week's video, we'll review the latest charts and data to help us answer the question, will rising interest rates bring a recession and bear market? We'll be moving quickly, so feel free to use the pause button on your video player. As we've mentioned numerous times in recent months, including in the January 20th, 2023 video, inflation, Fed policy, and interest rates have been and will most likely continue to be market wildcards for the foreseeable future. And as we've discussed in the past, it appears the secular downtrend in interest rates has been broken, and the bias in the coming years will be for higher interest rates. Thus, it's not particularly surprising that in September, the 10-year yield is challenging the Q4 2022 highs. A 10-year yield has moved quite a ways here since making a low in April of this year, so this is a new development, and it wouldn't be shocking at some point in the future if the 10-year yield made a run at 5.25, but that's to be determined. Right now, the MOVE index, which speaks to expected volatility in the U.S. Treasury market, it's relatively tame. An IEF, the 7 to 10-year Treasury ETF, has still not broken below the gap from Q4 of 2022. And it's noteworthy, when rates bottomed in October of 2022, failed 913 count here, and then a successful 913 count here. Similar situation over here. We have a failed 913 in June and an active 913 in early September, simply telling us to keep an open mind about IEF potentially making a stand in this gap and moving in this direction. And we should remain open to the possibility that the 10-year yield could fail to break out at this time. Not a prediction in any shape, form, or fashion. We'll see how it unfolds. When we review the weekly chart of AGG, a diversified basket of U.S. bonds, we can envision interest rates moving higher. If this was a left shoulder and this was a head, the right side of that potential formation is not particularly convincing at this point. The good news would be it hasn't broken down below these lows here yet. But the fact that the 200-week moving average is rolling over, prices below it, says a run of 5.25 may be in the cards sometime in the coming weeks or months. And if we think in extremes, if the 10-year yield moved from roughly 4.2% to, let's say, 8%, that most likely would cause some problems. And that concept is represented in this graph here. The takeaway, once the 10-year yield gets over 4.02%, the odds start to shift that higher rates will begin to cause problems in the stock market. Right now, we're still in the coin flip area. It's not overly concerning, but something that we need to respect. Similar look here with IEI. For now, we're still holding above this Q1 2023 low. And IEI has been trading within a wide range in calendar year 2023. This is a weakening, vulnerable look on the daily chart. And until we see some improvement, we have to be open to a break of this range and the break occurring to the downside. That may happen very, very soon. It just hasn't happened yet. Similar situation for international treasury bonds. They potentially have a second headwind in the form of the U.S. dollar. Also noteworthy, diversified basket of U.S. treasury bonds. Setup inside of the yellow box here. Make an argument it's similar to this setup here and similar to this setup here. Once again, telling us to be open to this range in 2023 potentially breaking to the downside. It looked vulnerable here in March, and it held. When we look at the ratio of JNK to IEF, it's difficult to believe that market participants believe that a serious economic crisis and/or a spike in bond defaults is right around the corner. Right now, market participants seem happy to take the extra yield that JNK offers relative to IEF and relative to IEI. This is a traditional fear look here in 2022. We've had a slowly improving look since the summer of 2022. This week, JNK divided by IEI still holding a multiple month long-term breakout. And the trend, blue the fastest moving average on top, black the slowest moving average on the bottom. That looks significantly different relative to this turn here. J&K in isolation, 200-week moving average. A tentative but constructive look. Concerns would increase if price rapidly moved in this direction. It's fair to make an argument. Earlier in 2023, price was below the 200-week, and in recent weeks, we've spent more time above the 200-week rather than below it. Similar situation for corporate bonds, indecisive. This chart could get healthy in a hurry if we moved in this direction, and the same can be said in this direction in terms of bearish probabilities. Interest-sensitive real estate investment trusts. It's an indecisive look here, but the bias is to the downside. But this chart too could get healthy in a hurry if price could move in this direction. Weekly US dollar, also a lot of sideways movement and consolidation. Looks like it's trying to break out to the upside, but hasn't done so yet. We always have to keep in mind that other countries may step in and defend their currency. And the dollar has moved a long way in recent weeks, but 104.84 here on September 8th, not radically different from where it was on May 25th here at 104.18. September 7th, weekly cloud still has work to do, much like this chart has work to do if the trend is going to flip. We've covered this chart many times, US dollar divided by the S&P 500. It's still fair to say this green line looks more like these green lines, and we look less like these red and concerning periods here. The larger chart is dated September 7th. Typically, when you get a look like this, good things happen in the stock market. Just as the MOVE index is currently tame, same thing for the VIX. We all know these instruments can move very, very quickly. Neither has moved yet. Since commodities impact the inflation, interest rate, and Fed policy equations, the improving look of this CRB index, a basket of physical commodities, is also noteworthy and also tells us to keep an open mind about higher interest rates. Having said that, CRB index is still well below the June high 2022 here. CRB relative to the S&P 500, still in a downtrend here, but trying to make a stand at a flattish 200-week moving average. CRB in isolation, price well above an upward sloping 200-week moving average, which aligns with the theory that in the future the bias will be most likely to the upside relative to interest rates and inflation, and the same can be said for stock market volatility. Like the US dollar, the CRB index weekly, the weekly cloud, has some work to do before we can say it's flipped from a downtrend back to an uptrend. The largest component of the CRB index also trying to make a stand at an upward sloping 200-week. That also tells us something about economic confidence in the state of the economy. But it's been over a year since light crude oil got to the other side of these moving averages, dropped below in July of 2022, stayed below. This is the first time we're back above. Also telling us to be open to further upside in commodities and potentially energy stocks. Energy stocks, XLE, remains well above an upward sloping 200-week moving average. And this tight cluster look here with blue, the fastest moving average on top, tells us to be open to a breakout from this long-term consolidation pattern, with consolidation being the key term. XLE was trading at $93.18 on November 11th, 2022. September 6th, the close below that level at $91.26. So for the most part, we've been moving sideways, but it's fair to say the bias here is for an upside breakout, but it hasn't happened yet. No real winner in XLK tech relative to energy here, and we don't want to get sidetracked by this. XLE in an uptrend, price above an upward sloping 200-week in red here. The same can be said for XLK, price above an upward sloping 200-week in red here, implying that both ETFs are in long-term long-term uptrends. We'll be using this VWAP chart here to monitor XLK relative to XLE. Gold has not done a lot, has not broken out yet, but price remains above an upward sloping 200-week moving average. And it's probably fair to say if we break out of a consolidation pattern that dates back to 2011, there could be significant upside. Given that both interest rates and commodity prices have been rising in recent weeks, it's probably fair to ask and answer. How is that impacting the stock market's bullish trend and the economic data? This is an anchored volume-weighted average price chart dated August 16th that we covered in the August 18th video. Said it wouldn't be shocking if the S&P 500 pulled back 6 to 10%. If we fast forward, nothing particularly alarming here yet. Price is above all of the anchored volume-weighted average price lines, telling us that buyers, from a longer-term perspective, remain in control. If we were to zero in on this window here, that is not the case. As of the close on September 7th, probably fair to say it's either evenly matched, and if you had to pick, the bias in the short run here still goes to sellers. But in terms of trying to be patient, lots of areas of potential support below price. It's relatively easy to stick with the long-term bullish trend if the S&P 500 stays above 4,100-ish. Starts to get a little more difficult in this area here, and a lot more difficult if the S&P 500 were to break 3880-ish, and maybe more importantly, this March low here. As you can see, prices significantly above those levels. And the slopes of the anchored volume-weighted average price lines up, all of them constructive with a turning up look. Mid-May in here was where risk appetite really took off. Thus, it wouldn't be shocking to come back and retest the 4,200-ish level. There's also a gap on the daily chart of the S&P 500 here. You can see two of the reference points here, gap near 4,200 on the daily chart, prior resistance at 4325. It's the moving average envelopes that we've covered in previous videos. This is the rollover look that you want to avoid in the year 2000. This is the constructive bullish turn look that you want to embrace. Bottoming process in 2003, early stages of a new bull move. And this would be the bearish rollover look that we would want to avoid. This is calendar year 2007. This is calendar year 2008. Thus, it's logical to ask and answer, how does the exact same chart look today? Better, worse, or about the same? Relative to 2008, the answer is much better. 2023 looks a lot more like 2003 relative to 2008, and/or the year 2000, and/or the rollover process in 2022. This question, the answer is, this looks similar to bullish turns. As far as the stack of the moving averages go, 50-day all the way out to the 200-day in orange, full bore bullish look, blue the fastest moving average on top, orange the slowest moving average on the bottom. And if we include price, we're still very close to a full bore bullish look. Momentum still looks vulnerable here, so additional downside would not be shocking. It's a daily DeMark chart of the S&P 500. DeMark charts and indicators are proprietary tools from Market Studies, LLC. This is as of the close on Thursday. While it may not feel that way, Thursday's low was still significantly higher than the low that was made in August at 43.35. Closed Thursday at 44.51, over 100 points above this low. 44.05 is now an area of potential support. If we can get back above 45.35-ish, then 47.34 starts to become real. That's 6 to 7% higher than where we closed on Thursday. The probability of additional downside if we can't hold 44.05 in the coming days. We're also on a 9/11 count here, telling us it's possible we'll see a constructive 9/13 when the market's making a higher low. That's all to be determined. If interest rates are rising, typically that's good for the US dollar. It tends to get stronger. And if the US dollar is getting stronger, it tends to be a drag on foreign positions when you own them inside the United States. As long as VEU can hold this area in here, roughly around $50 a share, and stay in the vicinity of these anchored volume weighted average price lines as it did in Q1 of 2023, then we will give the rally and the uptrend the benefit of the doubt. Concerns would increase if price moves into this area here. That may happen soon, hasn't happened yet. NASDAQ weekly still holding above this area here that acted as resistance in the summer of 2022. This is price on Thursday of this week, still well above an upward sloping 200-week moving average, telling us that the long-term uptrend remains intact. If we come down to the larger version of the weekly chart, you can see it in price here. Momentum is slowing, and you can see it in weekly MACD here as well. This green area here in 2023 is similar to this green area here in 2020. This orange box with slowing momentum here is similar to this orange box in the present day. Thus, it's noteworthy. Price consolidated in here for several weeks or several months and then resume the uptrend. It's not a prediction, it's just telling us slowing momentum in isolation isn't necessarily a long-term rally killer. As long as MACD remains above the zero line, this is classified as a counter-trend move within the context of an existing and ongoing uptrend. That would change if MACD dropped below the zero line, weekly MACD, as it did in Q1 2022. Yes, it's true that Fed rate hikes have been rare and rapid. However, financial conditions are still not particularly tight when we compare them to 2020 here, 2008 here, this recessionary window, the double dip window in the 1980s, and they're much more favorable in the present day relative to where they were in 1974. If the Chicago Fed National Financial Conditions Index popped above the center line as it did here, concerns would increase. That may happen soon. It hasn't happened yet. Like the MOVE Index, like the VIX, credit spreads currently tame. If they started to move rapidly in this direction, concerns would increase. That may happen very, very soon. It hasn't happened yet. Relative to the core data sets the National Bureau of Economic Research uses to declare whether the U.S. economy is in a recession, those data sets still look very, very good, and they do not look recessionary. We've already noted that there's nothing particularly alarming on this chart here. Since we use a weight of the evidence approach, let's review things in a broader context. Dow Jones Composite Average Daily. Still have a nice setup with the moving averages here. Concerns would increase if price moved into this area here. Weekly cloud, same Dow Jones Composite Average, checking all of the bullish boxes. So far, this is a subtle but constructive look. Dow Jones Industrial Average, been consolidating in this range here for a long time, and have had trouble holding above these blue lines. So far, we have a breakout and consolidation above those same blue lines. Very similar situation with the NYSE composite. This is the first time that price has consolidated above this blue line. We still have blue, the fastest moving average, on top, and now we have silver, the 250-day, the slowest moving average, on the bottom. Still a constructive setup, telling us to be open to movement in this direction. Like the Dow Jones Composite Average, the weekly cloud, checking all of the bullish boxes. That's much improved relative to the cloud profile in 2022. NYSE Composite Daily, anchored volume weighted average price lines. This looks like a bullish breakout, a retest, and so far a successful retest. Still with a somewhat vulnerable look here. This represents a band of strong potential support. Best case scenario, we stay above this red line here. But in 2023, we did retest this area and this area here. As long as price stays above these lines here, we would err on the side of giving the uptrend the benefit of the doubt. That would change if we take out this low here and these lines. Wouldn't be devastating if this uptrend was broken relative to the October low, but all things being equal, we'd prefer to hold it. We are seeing some subtle improvement with this data set spending more time in the blue box. We'd really prefer to see it get out here in the 300 to 400 range. If you're a stock market bull, you would really like to see this line turn up in a more convincing manner. This helps us keep an open mind about worse than expected outcomes until we get a more convincing look like this or this. Still holding above this area on the weekly chart. You can see the same area on the daily chart here. S&P 1500 index, slopes of the 50, 100-day, 150, and 200 remain constructive. Apple had a breakout on the weekly chart here earlier in the year. It's possible it needs to come back and retest this line here, still checking all of the bullish boxes on the weekly cloud. S&P 500 weekly still has a secular trend look. You can see the impact of the stronger dollar here, but still price is above an upward sloping 200-week moving average. FDN Internet, big laggard in 2022. Does have some give back here, but maintaining a bullish turn look relative to the trend. Black, the slowest moving average, the 250-day, is on the bottom. You can see hedged equity HEQ significantly outperformed SPY during the bear market in 2022. This week, underperforming. Another laggard outperforming this week. Previous laggard, IGV. Software outperforming VU by 2% this week. Still holding above an upward sloping 200-week moving average. Mid caps and small caps, both laggards, and yet both of them holding above an upward sloping 200-week moving average. Home construction, ITB, the historically highly volatile home construction, still holding this breakout here above the 2022 high and still a constructive trend. Big move here, so some give back would be 100% normal and to be expected. During Thursday's session, Russell 1000 growth outperforming SPY by a tick or two and holding above an upward sloping 200-week moving average. That looks significantly different relative to what was happening in calendar year 2022. Small caps are laggards, but small cap growth still with an improving look. In January of 2023, black, the slowest moving average, is on the top of the moving average cluster, as it was during the bear market in 2022. During this period of consolidation, it has moved from the top of the cluster to the bottom of the cluster, telling us to keep an open mind about small caps potentially breaking out to the upside. Global tech stocks relative to the S&P 500 or VU. When the relative trend flips back here in 2016, notice the amount of time it takes for that trend to turn. We consolidate, we consolidate, we consolidate. And by the time the trend flips, the 200-week moving average is ready to flatten out and turn up. Moral of the story, when we look at the slope of this 200-week moving average, it doesn't look like a vulnerable flattening outlook. This looks like a strong trend that got extended from the 200-week, and now it's come back to the 200-week. And during this entire process here, the slope of the 200-week still sent a message of strong trend. And even if we are going to roll over with this type of slope, it would probably take some time for this to roll in this direction. Similar situation with tech IYW relative to VU, still well above an upward sloping 200-week. Same can be said for the triple Qs, area of potential support, another area of potential support here if the correction intensifies. It's noteworthy that this area of support, potential support here, is still above an upward sloping 250-day in black. Very similar to small caps. Black 250-day, the slowest, is on the top in 2023 in January. It's worked its way to the bottom here. It's subtle, but it tells us we should be open to a break to this side. Very difficult to look at this chart on September 7th and say that it looks like the secular trend is in jeopardy. Same can be said for equal weight tech RSPT. Probably fair to say that this bearish turn in semiconductors really doesn't look anything like this bullish turn. Still well above an upward sloping 200 week, and it has been a broad rally. S&P 1500 still above an upward sloping 200 week. S&P 1500 still holding on to a constructive bullish turn look. It's possible we're going to have some give back. Absolutely, positively, yes, it's possible. Here's some give back here. Here's some give back here. Both of those episodes, counter trend moves within the context of an existing uptrend. Some regions of potential support for SPY. Strong dollar hurting foreign-based ETFs on a relative basis, but in isolation, FEZ still above an upward sloping 200 week. If the dollar stays strong and interest rates continue to rise, it's possible that even if foreign ETFs hold on to their bullish trends, from an opportunity cost perspective, there may be a better place for the capital. VEA, a lot like EFA, foreign stocks, some areas of potential support, price still well above an upward sloping 250-day moving average. This was the VEU chart that we covered earlier. If we look at the weekly chart, consolidation or weakness is also occurring above an upward sloping 200 week. No question the trend in European stocks has been weakening, but this weakness and consolidation is occurring well above an upward sloping 250-day moving average in black. Some noteworthy areas for VU. And we just said the stronger dollar tends to act as a headwind for foreign stocks, but if we look at global stocks, VT, clearly still in a long-term uptrend, holding this breakout here. And maybe it's fair to say some of the downward momentum has been dissipating. VT on August 23rd closed at 96.30. On September 6th, we closed at 96.89. Slightly higher than the level on August 23rd. This is what a long-term uptrend looks like in growth stocks. This is what a long-term uptrend looks like in growth stocks. Still looks like a long-term uptrend. That would change if this move in this direction fails and we're back down in this region here. Price holding nicely above the 200 week, and the 200 week looks like it's trying to turn back up in a more constructive manner. If we look at XLF, the larger banks, consolidating with some subtle improvement along the way. Still in a range. But notice how that consolidation has been occurring above an upward sloping 200 week. You can make an argument that this look here is somewhat similar to this look here. When we held in Q1 of 2016 above an upward sloping 200 week, eventually good things happened. When we failed near a flattish and rolling over 200 week, eventually really bad things happened. Still looks good. Still looks good. We could have some fairly significant give back, and that still would be occurring above an upward sloping 200 week in red. Same thing can be said for the upward sloping 250 day in black here, which has worked its way from the top of the cluster in Q1 of this year to the bottom of the cluster. Compare this look here to the bullish trend look over here. And contrast this look here with the bearish look here. S&P 500 peaks in October of 2007 here and does not bottom until March 9th of 2009 here. You can see the defensive-oriented XLP-SPY ratio. This is increasing fear as the stock market falls. You 2015, 2016. We don't make our final low until early 2016. You can also see the ratio is moving in this direction. Calendar year 2022, the S&P 500 is falling, the ratio is rising. Recent weeks, the ratio has been falling and below a turning down 200-week moving average in red here. This really doesn't look anything like this in early 2000. This really doesn't look anything like this transition here in 2007 and 2008. Dropping below an upward sloping 200-week moving average and then recapturing an upward sloping 200-week moving average. This XLY discretionary looks a lot more like the successful bullish stand near the COVID low, and this really doesn't look anything like this concerning slashing through the 200-week moving average look here in late 2007. It doesn't look anything like 2008. Markets in life can be nerve-wracking, thus it's important to have reference points. You may remember we used the Trend trend meter back in June of this year to make the case that the S&P 500 had resumed a secular bullish trend. And in that video, we noted that this constructive window here was approximately 27 years. This constructive window here was approximately 26 years. And we had a similar setup in June of 2023. And we also noted that the trend strength during the periods of secular stagnation, denoted by the orange boxes, the strength of the trend looked discernibly different in this red box, and this red box relative to the blue boxes. And when we looked at the strongest portions of the secular trend, the trend meter on a monthly basis tended to stay in the purple box. During the strongest portion of the move between 1982 and 2000, the monthly trend meter tended to stay for the most part inside the purple box. That's exactly what we had in June of this year, a constructive look. And in June, when we said we had a constructive look and we were in the purple box, the monthly trend meter was at 77.7. Thus, it's fair to ask and answer. Where do we stand today? Have we dropped out of the purple box? Do we look a lot more like the red boxes? Or does the secular trend look healthy and intact? Because if we're looking like this, or this, or this, then we would be more concerned about this, this, and this. And that's in stark contrast to this, this, and this. 77.7 on June 14th, 2023. How do we look today? Stronger, weaker, or about the same? Answer, stronger. September 7th, 2023, as of the close, roughly 88. So if we were to take this chart right inside the purple box, this still looks like this, and it still looks like this. It really doesn't look anything like this, this, or this. Simply telling us to keep an open mind about much better than expected outcomes looking out to 2034 or 2035, with plenty of 100% normal and to be expected volatility that would occur between a point A and a point B that could be several years down the road. To summarize, the bulls still have something to prove from a short-term perspective. However, the primary trend remains clearly up. Until this improves, this is possible. More downside and more pain. Inflation and interest rates, not surprising, they're causing volatility. It's not anything particularly new, and it's highly unlikely that it's going to go away anytime soon, and thus we should get accustomed to it. We need to get comfortable with feeling uncomfortable. In any environment, and especially in this type of environment, volatility is a necessary evil to try to navigate between a point A and a point B. Counter-trend moves are 100% normal and to be expected. It has been and it will continue to be important that we maintain realistic expectations about how markets operate in the real world. If the 10-year yield popped from 4% to 8% in a day as an extreme illustrative example. Probably be fair to say that the odds of some type of incident, failure, or accident or debt crisis would go up substantially. Thus, when interest rates are moving higher, we need to respect that risks are also increasing. And thus, we don't want to make any assumptions about any topic on any time frame. Just as we're doing this week, we're making our decisions based on facts rather than fear. We need to continue to do that every week. Trading the chart in front of you speaks to staying in the now. If we're worrying about what happened yesterday, last week, or last year, or we're concerned about what might happen in the future, it's going to be very, very difficult to stay focused so we can trade the charts in front of us effectively. And for all investors and traders, it's important to know your time frame. What is a bearish setup for a short-term trader can be volatility to ignore for a longer-term investor. And we all know the only way any of this is going to work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.